Top 10 Habits of Highly Successful Investors. Success in investing doesn't come from luck or mere intuition. It's built through discipline, patience, and a series of well-practiced habits. The world's most successful investors, from Warren Buffett to Ray Dalio, share certain principles and mindsets that set them apart from the average investor. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. 1. They start early and stay consistent. One of the most powerful habits of successful investors is starting early. Time in the market is far more valuable than timing the market. By investing early, they take full advantage of compound growth, allowing their money to grow exponentially over the years. Starting young also provides a learning curve. Early mistakes can be absorbed and learned from without devastating losses. Successful investors don't wait for the perfect time, because they understand there's no such thing. They begin with what they have and stay consistent regardless of short-term market movements. Even small, regular investments can build immense wealth over decades. This consistency develops discipline and removes emotional decision-making from the equation. Consistency amplifies growth through compounding returns. Starting early also allows more time for recovery from market downturns. Successful investors understand that consistency and longevity, not one-time brilliance, create real wealth. 2. They continuously educate themselves. Highly successful investors are lifelong learners. They don't just invest money, they invest in knowledge. They read books, study market trends, follow economic reports, and learn from their mistakes. Knowledge gives them an edge when evaluating companies, industries, or economic cycles. Warren Buffett famously reads over 500 pages a day because he believes that knowledge compounds just like money. These investors don't rely on rumors or tips. They analyze data, understand market psychology, and remain updated on financial innovations. By keeping their minds sharp, they can adapt to changing market conditions and make informed decisions that stand the test of time. 3. They set clear financial goals. Successful investors never invest blindly. They set clear, measurable, and realistic goals. Whether it's saving for retirement, funding a child's education, or achieving financial independence, they define their objectives and align their strategies accordingly. This clarity allows them to choose appropriate assets and time horizons. Without defined goals, it's easy to chase trends and lose focus. They break down long-term ambitions into smaller milestones, track progress, and adjust as necessary. This goal-oriented approach transforms investing from random decisions into a structured plan that drives meaningful outcomes over time. 4. They diversify their portfolios. Diversification is a cornerstone habit of successful investors. Instead of placing all their money into a single stock, industry, or asset type, they spread it across various investments, stocks, bonds, real estate, and even alternative assets like commodities or crypto. This reduces the impact of poor performance in any one area. Diversification doesn't eliminate risk, but it helps manage it effectively. Successful investors understand the balance between risk and return and tailor their portfolios to their tolerance levels. They know that wealth preservation is as important as wealth creation and diversification is their safety net. 5. They manage their emotions. Emotional control separates professionals from amateurs in investing. Markets fluctuate, sometimes wildly, and fear or greed can lead to poor decisions. Successful investors remain calm during downturns and resist the temptation to buy impulsively during booms. They understand that emotions are natural but must be managed. Instead of reacting, they respond based on logic and data. They set stop losses, follow strategies, and avoid letting short-term market noise derail their long-term vision. Emotional discipline ensures that they don't sell in panic or chase unrealistic gains, maintaining focus on sustainable growth. 6. They focus on the long term. Short-term market fluctuations are inevitable, but successful investors play the long game. They understand that real wealth is built over years, not days or months. Instead of obsessing over daily stock prices, they focus on the underlying value of their investments and the long-term growth potential. This mindset helps them stay patient and ride out volatility without fear. They view downturns as opportunities to buy quality assets at discounted prices. Their long-term approach compounds their returns over time, as reinvested profits continue to grow year after year. 7. They understand and manage risk. Successful investors know that every investment carries risk. Instead of avoiding it, they learn to understand and manage it wisely. They assess potential downsides before committing capital and ensure that no single loss can ruin their portfolio. They calculate risk-to-reward ratios, use stop-loss strategies, and diversify across asset classes. These investors also avoid excessive leverage, understanding that overexposure can amplify losses. Managing risk doesn't mean avoiding opportunity, it means ensuring survival through all market conditions. Their approach prioritizes preservation of capital first, growth second. 8. They regularly review and adjust their portfolios. Markets evolve, economies shift, and personal goals change, so successful investors regularly review their portfolios. They don't set and forget investments. Instead, they assess performance, rebalance asset allocations, and make strategic adjustments. This could mean selling overvalued assets, reinvesting dividends, or increasing exposure to new opportunities. Regular reviews prevent stagnation and ensure that investments stay aligned with both risk tolerance and market conditions. Through disciplined monitoring, they maintain financial agility and avoid unnecessary losses caused by neglect or complacency. 9. They value patience and discipline. Patience is perhaps the most underrated trait of successful investors. They understand that building wealth takes time, and quick profits often come with high risk. Rather than chasing instant results, they stick to their plans and stay disciplined through market cycles. They avoid frequent trading and focus on quality investments that grow steadily. Discipline ensures that they buy and sell according to strategy, not emotion. Even when others panic, they stay grounded, confident that patience will reward them through compounding and consistent market growth. 10. They keep their emotions and lifestyle in check. Many investors lose their wealth not in the market but through poor lifestyle choices, overspending, greed, or ego-driven decisions. Successful investors live below their means and reinvest their profits. They understand that wealth isn't built by flaunting it but by managing it wisely. Their lifestyle reflects humility and restraint, allowing them to save more and reinvest continuously. They also don't compare themselves to others. Instead, they focus on personal progress and financial independence. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.